is the founder of the National Financial Educators, and also co-author of the book Winning the Money Game, and also a association over at the Iowa Credit Union League. So everyone, here's Adam Carroll for you.
Thank you very much. Come on in.
Come on in.
Well, thank you all for coming today. I appreciate you being here, and obviously you're here because you want to know more about how to be more financially savvy about your credit score and save more money. To give you a little background on me, I graduated from the University of Northern Iowa. Go Panthers! Anyone? Woo. 2. Awesome. Okay, so we'll. When I graduated from UNI, I had $28,000 in student loans, $8,000 in credit card debt. I was upside down in my car. My dog had just died at home. My girl had left me at school. I sounded like a country western song. And when I got out, I took the first low-paying job that I was offered because I had bills to pay, and slowly got in this situation where I was spending more than I was making very quickly. And so I literally cried when I got my credit card bill because I didn't know how I was going to pay the finance charges. And as a result, I started learning some pretty drastic lessons about how credit scores work. And about that time, I met a woman who was the most financially savvy woman I'd ever met. She since became my wife. We had a merger. We merged. We've had 3 beautiful little dividends out of that merger. I like to call them 3 little tax deductions. And mind if I shut this down?
Oh yeah, sure.
So one of the things that she said when we first met was, "Get rid of your debt or I'm going to get rid of you," which I thought was pretty harsh, but good advice. So I did. And we've been together for just over 12 years now, and have lived life on the other side of the coin. We paid off all of our debt by the time both of us were 26. So we had no student loans, no car loans, no credit cards. We got rid of it all. The way I did that was I read about 100 books on money over the course of 24 months. I just picked up every book that people were recommending to me on the topic of finance and started reading and applying what I read. And one of the things that I began to understand was that we all have a credit score. It's sort of like our cholesterol. Not many people want to test it just because we're afraid of what it might be. And a lot of people will think that they have a negative credit score or a poor credit score, when in reality they probably have a pretty decent one. And some think exactly the opposite, that theirs is really rosy, and in fact it's not quite what it's cracked up to be. So today I want to tell you how to improve your credit score and save considerable money in the process. My goal is to have y'all out of here by at least 4:30 this afternoon. I'm kidding. I could not make credit scores that interesting to keep your attention for that long, but I'm going to do my best. So here's what 4 things your credit score determines. Number 1, whether you'll be approved for credit for mortgages, car loans, installment loans, and credit cards. And realistically, it's not only just whether or not you'll be approved, but it's what kind of interest rate you're probably going to receive on that. So how many of you have gone shopping for a vehicle in the last 2 years? Okay, and when you went, it's a harrowing process anyway when you're dealing with a salesperson. And then they say, we're going to take you back to the F&I manager, the finance people. That's where they really make their money. It's not so much on the sale of the car, but it's in the financing department. So what they do is they take your information down and then they send it out to a bunch of different banks that all vie for your business by quoting certain interest rates that they're going to give you on your car loan. And I'm going to tell you about some of the dings that does to your credit score. But most of the time, the F&I manager is going to try and push you towards whatever bank or credit union or financial institution is paying them the most, not necessarily the one that gives you the best interest rate. So it not only determines whether or not you'll be approved, but what interest rate you'll be at, which you'll see on number 2. Number 3 is the cost of your homeowners and car insurance. Years ago, they realized that someone's credit score is a pretty predictable indicator of how safe a driver someone is. Oddly enough, that if you miss a couple payments on credit cards or a home loan or your car loan, that in fact you may be more prone to an auto accident, and so they actually bump up your auto insurance charges based on your credit score. So just a little bit higher credit score can actually reduce your annual insurance bill significantly, which I'll talk about that. And then in some cases, whether you get that job offer you were hoping for. There's a good friend of mine in New York who, she graduated from a pretty prestigious school, wanted to go work for the magazine industry, and ended up getting an interview with a very famous magazine that has a big letter O on the front of it. You'll know what I'm talking about? And she went in, thought she nailed the interview, had a great time with the interviewer, and 3 days later got a call and they said, I'm sorry, you weren't selected for the position. And she said, she was crushed. She said, why, you have to tell me why I wasn't chosen. And they said, you know, we ran a credit report and we don't feel that you have control over your spending and because of your credit card balances. And because we're going to give you a corporate card, we're concerned that you might go crazy with that if you were in a bind. So in some cases, it does determine whether or not you get a job offer you were hoping for. The 3 credit bureaus are TransUnion, Experian, and Equifax. These are the 3 biggies that all of your information goes to. And these are credit reporting, these are the credit bureaus, and then there are credit reporting agencies that pull all the information from these 3. So the key is just know that these are out there, and that's what you'll see on your credit score, are 3 different numbers, and all 3 of them have different algorithms that they use to produce your credit score. So if someone said, well, how exactly do I calculate it? I would say there are 75 different calculations we could make that determine what the score is. So there's absolutely no accurate way of predicting exactly what your score is based on your situation other than plugging them into their systems. The things that make up a credit report, number 1, it's simply a record of all the credit activities. So it's all the payments, every amount you've borrowed. How many of you have pulled your credit bureau in the last year or so? And it's probably 16 to 20 pages long, right? It's all of the credit history that you've ever had in your life, including right after college when you were in that apartment and you ducked out 2 months early. The collection would still be on your credit bureau, more than likely, or at least show up in the history. It lists all of your credit card accounts and loans, balances, as well as your payment history, and it shows if any action's been taken against you, like judgments, liens, bankruptcies, etc. All of that is listed down at the bottom of the bureau. For your protection under the Fair Credit Reporting Act, which is enforced by the Federal Trade Commission, both the credit reporting agency and the organization that provides the information to the CRA, the credit reporting agency, has to correct any errors or incomplete information in your report. And it is on them to do so. So in fact, where this is a positive for all of you is if you get your credit bureau and you see some negative or misinformation that's on the report, you can actually go back to the credit reporting agency and or the organization that reported the information incorrectly and challenge them and say, I want this corrected. So how to apply this is, and where this came as a benefit for a lot of people was, if you've ever had a medical collection and you've gone and had a procedure done at a doctor's office, you pay your copay or whatever the amount you pay at the time of the visit, and then they send it into insurance, and insurance either pays it all or says, no, we're only going to pay part of it for whatever reason, right? And y'all know how insurance companies work like that, right? The doctors have to charge more in order just to get what they normally would charge from the insurance company to get it paid for. Anything left over can sometimes go back on your credit report as owed by you. Now, a number of these medical offices weren't keeping accurate records about the billing procedures. So what happened was there were a lot of medical collections showing up on people's credit reports. The individual, the consumer, would go back to that group and say, this isn't mine, prove that this was mine. And the collection agency that had now gotten it had no proof that that service had ever been provided for you, and because they couldn't validate that it was there, it would be expunged off your credit report. So literally there were medical collections that were just going away because these collection agencies didn't have the backup paperwork to support that this was your debt to begin with. Does that make sense? So the key to that is when you read your report, knowing that you have the ability to challenge whatever is in the report, because if it doesn't look correct to you, you don't recall the charge or the procedure or whatever it might be, then you can challenge it. And if they don't have the paperwork behind it, then it has to be expunged off your credit bureau, because the onus is on them to prove that it's correct. And I can certainly answer questions about that if you like. What makes up your credit score? The big chunk, 35%, is your payment history. It's basically, do you make all your payments on time? 30% is the amounts owed, which I'll talk about in a moment. 15% is the length of your credit history. So how long have you had credit cards open, or have you been in your mortgage, or have you had a car loan? 10% is new credit. 10% is the types of credit in use. So Someone who is just getting started in their work life and just has one credit card may not have as robust a score as someone that has had mortgages and car loans and credit cards over a longer period of time. So the types of credit and use is a big deal. Types of credit, credit cards, as I mentioned, installment loans, mortgages, and realistically, having a mortgage on your credit report actually is a benefit to the score because it's weighted just a little bit heavier than credit cards or car loans, installment loans. There are two ways to really boost your score. So how many of you have teenage children, college-age children? So one of the ways, if they have never had anything credit-wise in their history, they've never taken out a loan, not gotten a car loan, don't have a credit card, there are two ways to actually create a score artificially or to boost a score if they have one. Number one is put them on as an authorized user on one of your cards. And when you do that, you want to call the credit card company that's offering that card and say, I'd like to put my son or daughter on this card. Here is their social security number, and I would like this to report to the credit bureaus. So what happens is, in the next 30 days, the credit card company will run a report, send it to the credit bureaus, and they will now update all of that information for your son or daughter, and your credit history is now borrowed by them, so they now have this long credit history behind them. What that does is it automatically generates a score, or it may even boost their score if they don't have much to begin with. The second way, and I don't know, does Capital View have any credit builder loans? Yeah.
Not formal.
Okay.
But yeah, we've got things that we do.
Could do it. Okay. Yes.
Can you co-sign on a credit card for them? Is that the same as?
It's not quite the same. If you co-sign on a credit card for them, it's really still theirs. You are just on the hook for whatever they don't pay. So it's one of those. That's a trap that if you want to set for yourself, you're more than welcome to. But it's not necessarily going to help them as much as it would for you to borrow your credit history, because ultimately what we're doing here is trying to get the length of time, the length of history on there. Types of credit and use, again, for young people, if they go out and get a credit builder loan, which is basically a $500 or $1,000 loan. It's an installment loan from the credit union. And then what they normally do is they would put that amount of money in a savings account, and the payment every single month would be drawn off of that savings account. So you're basically borrowing $500 or $1,000, making the payment every single month. And at the end of that loan, you now show that you have the ability to handle an amount like $500 or $1,000, and it will actually boost your score because you have a paid in full account. Let's see. Payment history. This takes into account mortgages, credit cards, department store credit cards, car loans, and other installment loans such as for furniture and things like that. Generally speaking, things like your utility bills don't go on your credit report. There are in some instances in some states it actually will, but here I don't know that Mid-American Energy ever credits, takes payments or takes into account what the credit score is. Information from public records, bankruptcies, liens, lawsuits, foreclosures, judgments, wage garnishments, any late payments, such as the amount, how long ago it occurred, and how late it was. As a general rule, a 30-day late, and especially on a mortgage, a 30-day late doesn't kick in until 30 days after the payment was due, which you typically have a 15-day grace period on your mortgage payment anyway. So if your payment's due on the 1st and your grace period is the 15th, it may not be late until the 15th of the following month in some cases. Some lenders may call it 30 days late on the 1st of the next month if it's not been made. A 30-day late one time will affect your score a little bit. A rolling 30 where you're late on one payment and then you don't make it up the next month and you don't make it up the next month, but you're making a payment, it's called a rolling 30 because you've always been 30 days late, you just haven't made up that one 30-day payment yet. A rolling 30 is going to affect your score just a little bit more. A 60-day late, a 90-day late, that's where we start getting into some real trouble with the credit score. And usually after 90 or 120 days,